check this out. I just designed a whole life policy for a really big client, and he's putting in $2.2 million freaking dollars. So let's talk about this real estate developer that's putting $2.2 million into a specially designed and engineered whole life policy so that he then can use it to be his own bank, and he can use it for his real estate. So let's just articulate a little bit about that. Think of a big money developer that maybe you know or you've seen on TV. Hey, you can even think about Trump. He was a developer. Anyway, but let's just think about that. What do? They're always needing capital. They're always buying assets, and they're always developing land and buildings. And that all takes money. So where does that money come from? Well, if you get into the development game, you'll realize a lot of the money comes from their own pockets up front. They buy the land. They get the land already, and then they borrow money in most cases to then erect buildings and do the development. But a lot of times these developers use their own hard, cold cash to buy the land. Well, this developer that we're talking about was doing exactly that. He had a big tract of land he was going to buy. It was about $2 million that he was going to need to buy this tract of land. He was going to develop it into a 3-phased project. Some of the land was going to be developed and sold off to the D.R. Hortons of the world. Some of it was going to be used to develop single-family rentals, which the developer would maintain. And a couple of the lots would be sold off as single-family homes that they sell. So a 3-phase approach. But he needed to pay for the land. And up to this point, up until he met me and I talked to him about the infinite banking concepts, he'd always funded land using his bank accounts. But he never got paid on that money when he took the money out of the bank to buy the land. So think about this. He's got $2 million in the bank. He takes $2 million out, he buys this raw land, which he's going to develop. And over the next couple of years, it's going to pay him a good return. But a couple of years, sometimes 5 years, that land will sit and just be worked on and not produce a single dollar. He planted the seed, but the seed has not yet come to harvest. So when we talked about this policy, what it gave him the idea of, the worthy idea that was planted in his mind was, you can put this 2.2 million. Why 2.2 and not 2? That's the bad part. See, you can't just put 2 million in and take 2 million out in any policy we ever design, even if it's the most efficient design. There are costs. Remember I mentioned earlier, and I was thinking, what does this mean? Big commission. Well, yes, I get paid a commission. Although my commission I'm going to get paid on this policy I do for this developer is literally going to pay me about 90% less than what a regular financial advisor or insurance agent would make on a standard, off-the-shelf, whole life, or God forbid, somebody convinces you to do one of those terrible IUL plans. So I get paid 90% less, but I still get a commission. And where does that commission come from? The cash value in the first year. Essentially, there's going to be less cash value. So if he puts 2.2 in, he can only use 2 million in this design. That money that he wasn't able to use, that 200 grand, some of it's commission, not 200,000. That would have been a really good commission. But a lot of it goes to the cost of insurance because now there's no compounding yet. We just started it, and there's a policy service fee. So the fees in a whole life, okay, cost of insurance, policy service fee, which is usually $50 to $100, and commission, which the agent can dial the commission back by designing the policy to reduce their commission. And that's done by using things like term insurance riders and a lot less base policy. Anyway, I got another video for that, but let's get into it. So now the client puts 2.2 million in. He takes 2 million out immediately. Now he literally did this. His policy got issued, took about 43 days to get issued. He put the 2.2 million in, and immediately, maybe it took him a week, 2 weeks, we always say immediately in the first 30 days. So the second you make your premium deposit, within the next 30 days, you're gonna be able to take your first loan from the policy. His was very quick. So he put it in, and he immediately took it out, and he bought the land. Let's just do the math. He's got 2 million in the policy. Let's just use that number, in cash value. He takes a loan for 2 million to buy the land. How much money's left in his policy? 30 seconds. How much? Anyone say 2 million? You're absolutely correct. This developer learned what he could do different, and that what he could do different was put the money into the policy, change one thing, and that's where his money went first. Just move it from a bank into his own bank, the specially designed whole life. Then take a loan from the whole life to buy the land. Now he's got $2 million in his policy, earning guaranteed interest and dividends. he does have to pay interest on the loan that he took out. His interest when he did this is 5% was what he was paying. So he was making 6 with the insurance company we did, and he was paying 5. So we ran the math. It took a couple years to break even on the money he put in, but for the rest of his life, after those couple years of negative drag because of cost of insurance, the commission, and the policy service fees, for the rest of his life, he had a positive return, a positive non-cash return every single year that exceeded the cost of borrowing. Now, this developer also knew that banks are very finicky with lending. He also knew that when he needs money, a lot of times if he's going to borrow it, rates could be low, but rates could be really high. But the insurance companies have maintained really competitive and lower than prime interest rates. So I'm going down a rabbit hole, but just think about this. He found a way to take $2.2 million and put it to work and still use the money without interrupting the interest and dividend compounding he's earning on it. But he still gets to put it into the land and develop the land and make the money there. This didn't take him long to understand this concept. And then he said, okay, well, about these loans that I got to repay, normally I'd have to pay loans to a bank, so what am I going to do? I'm just going to take money from the property when it starts producing and just put it back into the policy? I said, exactly, but I said, let's go one step further. I said, how about this? When you take that $2 million out, figure out what a payment that would work for you would be on that $2 million. Like if your company lent another company money, what would they charge in interest? Let's just call it 6%. So let's just say he takes money from his policy, lends it to his company, okay? Personally, he lends it to his company. That's a capital injection into his entity. Now his company has income from rentals and everything else, pays him interest back. This is a circle, folks. The money goes from the policy around the top part of the circle into the land, the opportunity. The land produces a return, whether it's development, rental, or just the selling of those raw land to the D.R. Hortons to build it. That interest that he decides on, and he fully decides it, he's the bank, so he sets the rules. He then takes the money from the company and pays it back to himself. The amount he pays back to himself goes back into the policy as a loan repayment, which more than covers the 5% interest the insurance company charges, because if he's paying it back at 6 and the insurance company is charging 5, he's making a 1% spread. But the best part is, and this is why he didn't care about making payments back, it's all his money. He controls it all. He keeps it all. Every penny of every payment he makes back to his policy is his to use. He's just got to make an interest payment one time a year, which he's already doing anyway. You see, for him, it didn't matter. Every dollar, what he was doing before is exactly the same in this scenario, with the exception of in the first couple years, he can't use all of his money. So when you're thinking about this in your life, let's dial the numbers back from $2.2 million to $5,000 a year. Let's say you're saving $5,000 a year. I don't care what it's for. Maybe you're saving for vacation. Maybe you're saving to pay off debt. Maybe you want to buy a new house, a new car, a new whatever. Maybe you want to put an in-ground pool in. Heck, it doesn't matter. What you're saving for and what you're doing with that savings is what matters. I'm suggesting one thing, suggesting the same thing I did with that developer. Change one thing, and that is where your savings goes first. Instead of putting it in their bank, put it in your bank. And your bank, the same way the wealthiest families throughout history, from the Rothschilds to the Rockefellers to the Walt Disneys, the Ray Krocs, the Doris Christophers, the Joe Bidens, the McCains, I could keep going on. They've all done the same thing. Every one of them, look it up. They have changed one thing, and that is where their savings goes first. Everything else is the same. They're going to buy things, they're going to run political campaigns, they're going to open companies like Walt Disney World, they're going to open companies like McDonald's. They're using their money, but they changed where it went first because they understood a very important thing when it comes to money. And I'm just going to recite Albert Einstein, my boy. Albert Einstein said, compounding interest is the 8th wonder of the world. He said, those that understand it, earn it. Who earns it? That developer, Walt Disney, Ray Kroc, Doris Christopher, Rockefellers, Rothschilds, they're earning it. And those that don't understand it, pay it. So I know what side of the coin you want to be on. You want to be on the side of earning compounding interest. Well, there's no better way to earn compound interest uninterrupted. I mean, if I were to talk to Albert, I'd be like, Albert, hey, you like that compounding interest thing, right? But hey, what if we take compounding interest and we make it uninterrupted and we can still use the money? Albert, run some math. It's kind of like Bob Ross. We're gonna make
happy accidents
all day long, because there are no mistakes, folks. There's just happy accidents. The happy accident is, whoops, I decided to put my money into a specially designed whole life. But like I said earlier, 2.2 million doesn't resonate with many of you, maybe a couple, but 5,000 might. But what is the minimum? What is the absolute minimum you would need to start one of these policies? I don't talk about this enough, and I need to get this out there because you know what? We've been working with a lot of millennials and younger folks, and I love it. They don't have as much capital as the developer or the bigger clients we have, but they want to get started because they want to take back control of their money and they want to learn how to be the bank early because they understand compounding interest and they want to be the one earning it, not paying it. So here's the rule. It's so simple. How old are you right now? Yeah, put it in the comments. How old are you? You're 26. Great. Add a 0. How much is that? 26 plus 0 is 260. 260 a month would be your minimum. It's 10 times age, but it's just easier to add a 0. I'm 46, so if I wanted to start my 12th policy today and I wanted to do a minimum policy, 46, add a 0. 460 a month. That's the absolute minimum to make this work. Could you do it for less? Will other agents and advisors tell you, oh, that Chris guy's not telling you the truth? We can do it for a lot less. How much do you want to put into it? It will fail. It will not work. We've done the math thousands and thousands of times. We have over 8,000 clients. You think we've figured a few things out? We have. 10 times age is the minimum. How much is the maximum? Sky's the limit. That developer put 2.2 million in, and that's just one of his many policies now. So it all goes by what amount you want the ability to save. When you're starting your own private banking system, how much do you want to be able to capitalize your bank at, right? That's it. Is it 10 times your age? Is it $260 a month? Because my very first policy I ever started, I was 24 years old. I put a little over $240 a month. That was my first policy. That policy today has funded so many different things, I can't even remember what it's funded. Plant the seed. There's an old Chinese proverb that says, when is the best time to plant a tree? 20 years ago. When is the next best time? Right now. What are you waiting on? Why are you not planting this new idea? Is it because you're conforming to what everybody else tells you to do? Is it because you're literally listening to people that don't live the life you want? People that have failed in their financial journey, but then they're gonna tell you, oh, that Chris Naugle and that whole life stuff, that's garbage, don't do that. How do they know that? Have they done it themselves? Has it failed for them? Because with 8,000 plus clients, please tell me, there's gotta be some negative stuff out there in the internet. There's gotta be Reddit articles saying that
Chris Naugle guy doesn't know what he's talking about. Not one.
How could that be? Well, it's not because we got a patrol going out there deleting all them. You can't do that. It's because it actually works, which is why people put $2.2 million, which is why banks put trillions of dollars into BOLI policies, bank-owned life insurance, which is why all the wealthiest families have used this. So I want to give this deck away to somebody, but I'm going to make it a little bit difficult because these are limited edition and when they're gone. So here's what I'm going to do. For the one person that watches this video today, that actually takes action to go back and find an old video, a really old video on my YouTube, and there's over 900 videos. You gotta find the old video, and I want you to literally send me an email, and I want you to tell me one story about Fat Man board shops that is absolutely certain from one of my videos. If you could find that, and you can recite it back to me in an email. My email is chris@themoneymultiplier.com. I will then read it, respond, you will send me your address, and you will get a limited edition BYOB deck. That's my commitment to you. So with that being said, folks, today, thanks for letting me share a couple stories. Thanks for letting me brag a little bit about my client that I just did, that I was able to help them solve a really big problem. And folks, I hope I someday get the chance to solve one of your problems. Hey, and if you like this video, check this one out, how to design an IBC policy updated. This takes you behind the scenes on how we design these policies so they work for the infinite banking concept. See you next time.